Let's take a look at that number and clarify things here, because 67% drop in quarterly profits. It's on a quarter-on-quarter basis. If you're looking on that year-on-year figure, we're actually looking at a significantly improved operation.
Massively improved. Yeah, we're talking 957 million versus the previous year at 4. If you look quarter-on-quarter, the quarter is not bad, but remember last quarter was very good because we had a big tax benefit. So quarter-on-quarter, because last quarter was so good from that tax benefit, of course this quarter doesn't look so good. But quarter-on-quarter, you know, we're looking good. Everything about Harmony is looking where we want it to go. We're in the right direction.
Well, we'll be getting into the positives in just a bit. Let's hone in on some of the pressures, though, because that rising cost base is really coming to bear, not only on Harmony, but for the industry as a whole. How are you starting to manage that and mitigate against some of that risk? Because it's a feature that isn't going to going to be going away anytime soon.
Yeah, some of the big numbers, of course, are labour and electricity, and they make up roughly about probably 80% or 75% of our costs. And so, you know, that's a big cost. So electricity, of course, gone up 25%. We also have winter tariffs, and you can't avoid that. So there's 1 month of winter tariffs. Next quarter we have 2 months of winter tariffs. So the increases in electricity are quite high. We're now at around about 15 or 16% of our costs, our total costs of electricity. So that's big. Labour costs, of course, are fairly substantial, in the region of 52 to 54% of our costs. This particular quarter that we had, of course, we had quite a few public holidays. Public holidays are good in some ways and bad in others. Bad because you can't get normal production, but good in that the guys did manage to get some extra production, but at extra cost. And then we had one of our assets actually coming out of capital and into sort of operating costs, so that distorted the costs.
We had Ian Cruikshanks of Nedbank Capital highlighting that miners have had to become a lot more innovative moving forward in terms of how they tackle that rising cost base, and he highlighted specifically automation of operations as a sticking point. Run us through that, and does, you know, that employment of 40,000 people thereabouts stand at risk at this stage?
Yeah, I think there's a lot of, you know, engineers have been working hard on, for instance, electricity costs, you know, getting electricity costs. We recirculate water, making that water work for you, generate power from it, using various sort of technologies to try and reduce your electricity bill, reduce your sort of reliance on people. So where you can automate things in plants and so on, you can do that. We still have, having said that, we still have a very labour-intensive business. In the gold mining, narrow reef mining is a very difficult business to automate and to mechanise. So we're still very reliant on labour.
Okay, so that doesn't stand at risk at this stage of the game, because you need those employees to actually go underground and do the work. Let's take a look at some of the other cost pressures, because there's costs related to Target 3, which is a shaft you bought from troubled miner Pomotsi Gold. And the merit of that purchase as it stands right now, despite the impact it's had on this set of numbers?
Well, this set of numbers, of course, are unique because it's not in capital now, it's now in operating costs. And as we ramp up production from that, which we will do as we go forward, and so the costs will come down. So, you know, it's one of those quarterly abnormalities, but from next quarter you'll see this sort of increase in production, and therefore the cash costs come down.
Harmony's failed to provide a target for next year, though, when it comes to those production targets. Is there a specific reason for that?
Yeah, there's a very specific reason. Next week we've got an Investor Day, and so in our presentation we said, Investor Day will give you all the targets and everything for next year. So we didn't avoid targets, we've just delayed it for a week and just saying we'll give all the targets.
So we hold our breath until then to see what actually comes to the fore. In the meantime, we've had analysts very optimistic about your operations, your Papua New Guinea project, Wafi-Golpu in particular, and you've said time and time again that this is going to be a game-changing region for Harmony. Let's go through that potential we're looking at there.
Yeah, I mean, that ore deposit is now over 1 billion tonnes. It's a big deposit. It is simply the highest grade copper gold porphyry around. It's in the region of 1% copper. Most other big copper porphyries of the world are probably closer to 0.6% copper. And it's got good gold grade, so it's a great deposit. It's working well in the JV with Newcrest as we have it. So and we're going through the pre-feasibility study. That will have sometime during the next, well, certainly before June next year, but probably in that sort of first half of the calendar year next year. And that'll give a bit better guidance on sort of production rates, costs, capital costs, and so on.
And challenges as well. I mean, how does that kind of environment compare to the local operations here in South Africa, especially on that cost front?
Well, we're talking a big mechanized operation in PNG, something that we're testing somewhere between 20 and 30 million tons a year. So it's a big operation, a mechanized block cave. It's certainly going to be a good asset from that point of view. If you just look at gold point of view, it'll have negative cash costs, so it'll be great.
Of course, despite those operations that are underway there, I mean, the bulk of Harmony's assets in South Africa, the bulk of gold, though, in the world is not here anymore. Apart from Papua New Guinea, are there other opportunities you're looking at?
There are always opportunities that we look at, but right now with the high gold price, of course,
it's becoming expensive.
Become more expensive. So,
absolutely.
Right now we've got some very good assets. We've transformed the company dramatically from what Harmony used to be as sort of a high cost, marginal, short life, and now we've got some long-term assets which are much bigger and much better, and so we've got a good future within Harmony without actually looking outside. But we're always on the lookout for things.